Hello and welcome back to a new Stock Toolbox video. Today I will talk about momentum stocks, relative strength index, and FOMO, which is fear of missing out, which fuels this momentum movement. Momentum means that if a stock is in motion, like in upwards motion or downwards motion, then it stays in that motion for a while, and once it changes, then the momentum is broken and people sell their stocks if they bought them for the positive momentum. Once they stop going downwards, then people stop shorting stocks if they bought them for downwards momentum. And fear of missing out fueled stocks like Tesla, Amazon, and Apple recently, because everybody thinks they will lose money if they don't buy them. And then there's a run on stocks, and then it could be like in the year 2000 when there was a dot-com bubble, and 2008 when there was the housing market bubble. And it's kind of a risky investment style, and I only have one stock that was profitable with this, and it was my only stock I bought for the momentum. But the main criterion for buying it was the two-stage discounted cash flow model. And the stock went up like 20%. I thought, I don't want to buy it right now because it already went up 20%. But my calculations showed that the stock should keep going upwards. I bought it and I'm up like 3 times with that stock already. And now onwards to the next free toolbox tool to show you stonks only go up. And don't forget to subscribe if you enjoy it. Here you see all of the boxes that you can check if you want different results, and ideally you just check the boxes that you currently work on. And the first one is load historic prices. One book I used for my research mentioned that if the stocks had gains of 50% over the last 6 months, then it's less likely to get another 50% gain. And it didn't mention if it was a simple return or compounded return. Therefore I used both, and I compared the price of half a year ago and 1 year ago to the current price, then the simple return and the compounded return, and I did add some data. I'm not sure how to use it yet, but maybe you figure it out. Then the Yahoo URL, then the Spark/Trendline. It's really funny because if you compare all of them, you can pretty much see where the market crash of 2020 was. And then we have the comparison of the current price compared to the different moving averages. And this one is a strong indicator if the stock is going up for 4 or 5 days continuously, and each day has a higher price than the one before at the closing time, then there will be a momentum. But currently there's no. Then we have the moving averages from 5 to 200 days. Then we have the beta, then volume and volume average. And this one is a comparison of the current volume to the average. And if it's above 100, it means it could be a trend change, because then the current trading volume is way higher than the usual. And these are the important parts. They load most of the data. Then we have all of the data and comparison, how much gain, loss, and then the relative strength and the relative strength index. They are hidden in there. You can open it up and it's a huge load. And most of the time it can be hidden. Just go over it quickly. If it loads. Then we have the gains, loss, relative strength, and then the relative strength index. And then you have the relative strength, and then you can check which prices are currently the strongest and they had the most gain recently. And usually if people use the relative strength index, they want to buy it if the strength is currently low and it's gaining momentum, and they sell them once the strength is really high. But if you want to go with the momentum approach, then it could be advisable to go with the stocks that had the most gains, and then you compare it. And I also added some backtesting, and you add how many days you want to backtest. Then the start is 5 days prior and it ends 5 days sooner, and you can change it to whatever you like. And then if you check this box, then it starts the backtest, but you have to do it yourself mostly. But the start date and the end date are 5 days sooner, as you can see now, after it's done loading. Before it finishes loading, I show you some other stuff. This one is an error message, and it appears if the yesterday closing price doesn't align with the 0 for the moving averages, and it gets skewed a bit. So you have to go to this cell, and if you change or add some new ones, this one should also update. And then you go to the important ones and then you change it. And for example, if it's delayed by 201 days, but if it's too far to the left of the 0, you see to the right, if the data ends too far to the left of the 0, like here, then there will be an error message, the one that you saw before. And if the data sets end to the left of the 0, for example, like here, you need to increase the number of 201. And if it's too far to the right, then you need to decrease it. And there is another control mechanism. If you change this one, it also has the big in caps, then you see that there's a duplicate. Because of this formula, it only shows unique ones, so it doesn't show any of these stocks twice. And then you have the duplicate error message. Once you change it back, the duplicate should disappear. And these two columns are currently placeholders, and they will be used later on to show stocks that are non-US correctly. And they can be hidden usually. And for the backtest, if it's checked and the 5 days, you see that the starting date is the 7th of February 2020. And if you uncheck it, it should turn back to the 30th rather quickly. The starting date should look like this then, if we change it a bit. And if you watched my last video, you will know this sheet probably. And you can put in all of your stocks that you want to have analyzed by me in there. I copy paste them and put them into this sheet, and I add which country they are from. And then I will have some returns, and I use a 2-stage discounted cash flow model. I used these rates, and I used the free cash flow average of the last few years. Then over the next 10 years, I calculated with a growth rate of 5. And after the 10 years, I use an infinite growth rate of 3% and a discount rate of 7%. And discount rate could be like a government bond, which is very safe, and 7% is way too high. But then the values that I get are more conservative. In this column, you can see the debt to free cash flow ratio. And if a company has a lot of debt, then it takes them many more years to pay off all of the debt with the free cash flow. And for Walmart, it would be like 9 years. And then I do some guessing depending on the numbers I get. And if with my formula, the calculation shows that the stock would return 100% over the next 10 years, then it would be a decent evaluation. If the stock has like 600% return, then it would be labeled as interesting. And if it has less than 100% return over 10 years with my calculations, then it should be as I don't like it. And for a 2-stage discounted cash flow model, I subtract all of the debt at the end, and then I compare it to the market capitalization. If I don't like a stock, it could mean the stock has too much debt, or the market capitalization is already very close to the value that I think it would have in 10 years, or it has very weak free cash flow. And if this one turns out well, I will do some weekly updates where I show you all of this, my portfolio value, and show you all of the stocks that I like during a week from the community. If you enjoy my content, please subscribe, like, share, and hit the notification bell so you will see new content more reliably and you don't miss out. And as always, you can find the extra sources. One of the books I used is a book that's really expensive. It costs $150 and therefore I added the free link from archive.org over there, and you can read up all of the other stuff in there. Thanks as always for watching, and until next time. Bye bye.